Ladies and gentlemen, good day and welcome to the L&T Technology Services Limited Q1 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pinku Pappan, Head of Investor Relations. Thank you, and over to you, sir.
And welcome to the earnings call of L&T Technology Services for the first quarter of FY24. I am Pinku, Head of Investor Relations. Our financial results, investor release and press release have been filed on the stock exchanges and are also available on our website, www.ltts.com. I hope you have had a chance to go through them. This call is for 60 minutes. We will try to wrap up the management remarks in 20 minutes and then open up for Q&A. The audio recording of this call will be available on our website approximately 1 hour after this call ends. With that, let me introduce the leadership team present on this call. We have Amit Chadha, CEO and MD, Abhishek, COO and Executive Director, Arvind Saxena, President Sales and Executive Director, Rajiv Gupta, CFO. We will begin with Amit providing an overview of the company performance and outlook, followed by Rajiv, who will walk you through the financial performance. Let me now turn the call over to you, Amit.
Sure. I hope I'm audible and clear. Thank you, Pinku, and thank you all for joining us today on the call. Trust all of you are doing well. Let me provide you key highlights on our Q1 performance. We had a quarter of growth despite the macro challenges and slowdown in decision-making in pockets. Overall, we grew by 10% year-on-year in constant currency. The comparison on Y-on-Y is more like-to-like given the fact that H2 is always higher than H1 for the Smart World business. Our revenue grew by 0.6% sequentially organically, with transportation leading the growth at 4%, while medical and industrial had about a 0.5 to 1% growth. Overall, sequential growth organic was 7.5% CC. Operational performance was strong with EBIT margin at 17.2%, which is post the addition of Smart World. PAT at 311 crores were up 13% Y-on-Y. Our large deal engine continues to fire with a total of 6 deals above 10 million, of which one of them was a 50 million deal TCV that we signed this quarter. All deals have moved to execution. On other dimensions, happy to share that we filed for 55 patents for our customers and ourselves, taking the cumulative count to 1,145 patents. We were rated as a great place to work in India again and Poland for the first time. Attrition is down 330 bips to 18.9%. We expect this trend to continue. Moving on to segmental performance and outlook. Starting with transportation, strong show of 4% quarter-on-quarter growth that was broad-based across auto, trucks and off-highway and aero. Demand continues to be strong, led by EV and connected cars in auto electrification, in trucks, in off-highway and avionics in aerospace. We won a 10 million plus deal with a transportation customer who had earlier chosen us as their preferred engineering partner. We continue to invest in transportation capabilities for the future, like software-defined vehicles. We are working on creating a digital architecture for future state software-defined vehicles that will require a centralized platform with high computing processing power, cybersecurity, and high-speed connectivity. We have filed 8 patents in transportation in this quarter. My colleague Abhishek, as required, will provide more details on software-defined vehicles. In the connected car area, we are seeing incremental opportunities to manage SOC, NOC by leveraging Smart World capabilities. Overall, we see a good pipeline of opportunities across all subsegments and expect the growth momentum to sustain. In plant engineering, This differentiated segment remains on solid footing. Q1 was a one-off as we were impacted by decision-making and supply delays by customers that slowed down the pace of ongoing projects. We see a bounce back in the next quarter as the pace of decision-making, regulatory and other factors have seen an improvement in June and July. FMCG customers are undertaking capacity expansion as they move towards more localization. We have won a 15 million deal from a global agri-food company to provide engineering design services for the new plant in Europe. Will also help us set up a local office in Europe for plant engineering and strengthen our European presence. This large deal, along with a few $5 to $10 million deals that we won, gives us good growth visibility in Q2 and the coming quarters. Across all three subsegments of ONG, FMCG and chemicals, we are seeing good opportunities on the sustainability side with companies wanting to use advanced technologies to recycle water, waste, plastic, etc. to meet their sustainability goals. We are confident of growth in plant engineering in Q2 and beyond. At industrial products, we grew slightly on the back of the demand and good demand from the machinery and electrical segment, though we were hit by decision delays in building technologies and power segment. We see a rising adoption of digital in multiple areas like supply chain and productivity improvement under the larger Industry 4.0 initiatives. This is leading to an increased scope for deploying AI, private 5G, and cybersecurity as spends on software platforms, factory automation, and sustainability increase. We are focused on making accelerators and reusable solutions that can be used to reduce the time to market and improve ROI for customers. This segment filed 20 patents in this quarter and remains a flagship segment in innovation. We won a 10 million plus deal in Cuba with a US customer to optimize supply chain and improve manufacturing efficiency. Overall, we see a good pipeline of opportunities in the digital space and expect the growth momentum steadily to build up in industrial products. Moving on to telecom and high-tech, organically we had a marginal decline, although when combined with SWC, we were up year on year. Let me discuss organic telecom and high-tech business first. The key highlights of the quarter was a 50 million deal with a US-based high-tech customer to enable new opportunities for digital video platform. We will enhance their suite of products and optimize it for better user experience using AI and generative AI as we move forward. We are seeing more such opportunities in the media subsegment as customers look to engage us to develop their next generation digital platforms. As we had indicated in the previous quarter, there is a weakness in the semiconductor side. While this industry is still in inventory correction mode, we are moving up the capability spectrum and winning some deals in this area. I would like to highlight a post-silicon validation deal that we won in Q1, which will involve setting up a design studio offshore. As we partner with chip companies to develop new age chips for cloud computing, data center as well as automotive industry, our growth is set to pick up. We are also seeing good opportunities as global ER&D companies move manufacturing from China to India. One of the 10 million plus deals we won in Q1 is of that nature, where we partnered with a global technology giant to provide next-gen wireless and product engineering from design labs that we have set up in India exclusively for the customer. On the Smart World side, we have fully integrated this into our telecom and high-tech organization with a dedicated sales team and leadership in place in the US, Canada, Europe, Singapore, and the Middle East. The operational improvements will be discussed by Rajiv in his commentary. Let me share the progress in two channels that we have activated for Smart World. One, our game plan of taking Smart World global has seen early wins, including critical partnerships with telecom service providers, equipment manufacturers, and execution of these deals should start in Q2. I am thankful also to our enterprise customers who are actively engaging with us on specific opportunities in next-gen communication, some of which should close shortly. We were awarded cybersecurity deals, which have already started execution. The Smart World business requires an ecosystem play. To this end, we are working on our partnerships with key players. You would have seen the announcement of LTTS partnering with Palo Alto Networks to provide enterprise with operational technology and cybersecurity services. Teams have been formed on either side to take it forward. Another one is a partnership with BSNL to drive and enable global enterprises in their private 5G network deployments. With Qualcomm in North America, LTTS is working together to offer 5G-driven next-gen connectivity solutions. This leverages LTTS's chip-to-cloud expertise. In Q1, we had a few wins in next-gen communications overseas, and we see the momentum building with the pipeline increasing. We believe the measures we have taken will create a robust foundation for future growth and transition this business from domestic only to a mix of domestic and international business. Summing up, we do see growth in the combined telecom high-tech portfolio driven by media and telecom. However, the Semcon challenges may persist for another quarter. Lastly, in medical, we see strong demand for digital as customers prioritize areas like medical devices as a service, connected devices, and cybersecurity. In Q1, we signed a 15 million plus deal to design and develop a digital surgery platform that will connect with customers' robotics, surgical and operative devices and be used to deliver better outcome for patients. We are building reusable solutions for various areas like complaints management and QARA. The pipeline of deals gives us confidence that our growth momentum should improve as some of the large deals close. Let me now discuss the outlook. Our growth is tied to our long and strategic relationship with customers. I am happy to share that we had our first customer advisory council in Washington, D.C., comprising of CXOs, board members of 16 of our customers with a collective market cap of $2 trillion and a revenue of $400 billion. These organizations are advising us on our direction and investments so that we can bring more relevant offers to the market, build stickier relationships, thus helping us elevate our customer lifetime value journey. The large deal we won in the quarter are an affirmation that our customers continue to spend on transformation technologies. We remain front and center as a choice provider to them, and we can deliver speed to market, cost synergies, and innovation. We are accelerating our investments in 3 emerging technologies: AI, software-defined vehicles, and cybersecurity. I talked about our investment in software-defined vehicles in our partnership with Palo Alto for cybersecurity. In AI, our focus will be auto, manufacturing, medical segments, and we will partner with hyperscalers and Semcon companies for joint development of readily deployable solutions. We are strengthening our AI team in the coming months to achieve our goals. Let me conclude by saying that we grew in Q1 despite delays in decisions and deal closures getting pushed out. The pace of deal closures has improved from June, which combined with a healthy deal pipeline, which is bigger than year-on-year and quarter-on-quarter, we see gives us the confidence of growth momentum strengthening in the coming quarters. We maintain our FY24 guidance of 20% plus in constant currency. We also reconfirm our aspiration of $1.5 billion run rate in FY25. Let me, with that, wish you good health. We'll stay up for questions. Thank you so much, and I hand over to Rajiv now.
Thank you, Amit. Good evening to all of you, and I hope you are keeping safe and healthy. I'm pleased to share our Q1 FY24 performance. It has been another quarter of good results with healthy additions of deals and operationally strong performance. This is our first quarter of reporting financials after completion of the SWC acquisition. In compliance with NDA's requirements applicable to common control transactions, we have restated our past financials to include SWC from 1st April 2022. As a result, all figures in the investor release include the comparison reflecting these restatements. Let me take you through the Q4 FY24 financials. As said earlier, throughout the commentary, I will elaborate on the restated combined financials that include SWC in all the comparable quarters as well as organic numbers excluding SWC. Starting with the P&L, first to address revenue. Organically, revenue for the quarter grew 0.6% on sequential basis and 12.6% on Y-on-Y basis in INR terms. On the combined financials, revenue for the quarter was 2,301 crores. A Y-on-Y comparison is more accurate indicator as Q1 FY23 numbers have also been restated to include SWC. On a Y-on-Y basis, our double-digit growth trajectory continues with Q1 revenue up 14.7%. SWC business at current state delivers higher revenues in H2 as compared to H1 on account of seasonality. Moving to EBIT. Earlier in our Q4 commentary, we had indicated that we aspire for FY24 combined EBIT margin to be in the range of 17%. I am pleased to share that our Q1 FY24 combined EBIT margin came in at 17.2%. Let me explain the evolution of margins from 18.7% that we reported in Q4 FY23 to the 17.2% in Q1 FY24. Organically, EBIT margin was slightly down on account of investments made for large deals. Amit did refer in his opening comments around a large deal that we won, a $50 million deal in high-tech segment. As we had highlighted earlier, SWC business has a lower margin profile. Hence, on a combined basis, Q1 FY24 margins have come at 17.2%. Overall, we've been able to integrate SWC as planned and maintained operational performance within the range that we had aspired for. Moving to below EBIT, talking about other income came at 35 crores, slightly lower on a sequential basis due to lower income from investments, primarily due to cash outflow of purchase consideration of 800 crores for SWC acquisition at the beginning of this quarter. Effective tax rate for Q1 was 27.6%, in the same range as our expectation of 27.5%. Net income for the quarter was up 13% on Y-on-Y basis and came in at 311 crores, which is 13.5% of revenue. Moving to balance sheet, let me highlight the key line items. To begin with DSO for the organic business was 92 days versus 90 days that we had reported in Q4 FY23. As indicated in our previous commentary, SWC is a high working capital business and had DSO of over 400 days at the time of acquisition. We are pleased to inform that we have improved on the DSO of this business since then. On a combined basis, Q1 FY24 DSO has come at 117 days within our expected range of 115 to 125 days for FY24. Needless to say, we will continue our efforts to improve on combined DSO. On shareholder funds was at 4,817 crores at the end of quarter one versus 4,951 crores that we had reported at end of Q4 FY23. As per accounting standards applicable to the common control transaction, the excess of purchase consideration paid over the net assets acquired is shown as a reduction to shareholder funds. The reported value of 4,817 crores therefore reflects the adjustment of this impact. Now talking about cash flows, our free cash flows came in at 228 crores, a healthy 73% of net income. This reflects our operational rigor on improving combined DSO. Our cash and investments rose to 2,394 crores by end of Q1 FY24. This is after payment of 800 crores for the SWC acquisition. Moving to revenue metrics, on the combined financials, dollar revenue was up 9.1% in reported terms and 10% in constant currency terms on a Y-on-Y basis. Organically, dollar revenue saw 0.6% sequential growth both reported and in constant currency, led by transportation segment. The segmental margin performance was better in 2 out of 5 segments on a sequential basis. Our telecom and high-tech margins came in at 8.8% in Q1 versus the then reported 12% margin in Q4 FY23. This is on account of lower margin profile business of SWC and investment made on large deal win. We expect the margin trajectory to improve as we transform SWC business. Moving on to operational metrics, to begin with on-site offshore mix. Offshore percentage now stands at 59.3% compared to around 57% then reported in Q4 FY23. This increase reflects the fact that currently SWC business is completely offshore based. Talking about T&M revenue mix, fixed price percentage is at 35.6% compared to around 29% then reported in Q4 FY23. SWC business is largely executed on a fixed price model. Talking about client profile, which indicates number of $1 million plus accounts, has shown a sequential improvement in the 30 million, 20 million, 10 million plus and 1 million plus categories. The client profile numbers have seen an improvement over the past few quarters, and this trend will continue in the coming quarters. SWC has added few large customers to our client base, including one $30 million and 3 additional accounts of $10 million plus. Talking about client contribution to revenue, on a combined basis, top 5, top 10 and top 20 have shown a slight uptick as compared to Q4. Moving to headcount, headcount stands at 23,392 at end of Q1 versus 22,233 then reported end of Q4 FY23. This sequential increase of 1,159 employees includes the addition of around 800 people from the acquisition of SWC. On attrition, pleased to share that it declined to 19%. This is as a result of various efforts on employee engagement. We believe this trend will continue downwards. Realized rupee for Q1 was at 82.2 to the dollar, flat compared to Q4. Before I conclude, let me give some visibility on the EBIT margin trajectory going forward. We continue to focus on profitable growth and maintain our operational rigor. This will help us achieve our aspiration of 17% EBIT levels in FY24. In Q4 FY24, we will offset headwinds from wage hikes that are effective July 24 through a combination of growth and operational efficiencies. This is as planned to roll out wage hikes committed to our employees. In the medium term, we aspire for 18% EBIT levels by H1 FY26. With that, thank you to everyone. Moderator, now we can take the questions, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their questions to 2 per participant. For follow-up questions, you may rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mukul Garg from Motilal Oswal Financial Services. Please go ahead.
Yeah, hi, thanks. So Amit, just one question from my side, and I think, sorry about this being a recurring topic, but given the, the delays and push-outs which you saw in the first quarter, what is giving us the confidence of, delivering a 10% organic growth, in FY24? What really are you seeing in terms of client visibility that such issues might not recur anytime over the next 3 quarters? Because currently, if I kind of do a rough number crunching, it looks like your compounded quarterly growth rate would be upwards of 4% for the next 3 quarters. So if you can just help us walk through, what really is the kind of behind this confidence of maintaining the revenue growth.
Yeah, hi. Thank you. Thank you, Mukul. So, couple of things here, and I'll answer it broadly. So, if I look at growth, some of the deals did get delayed in terms of decisions. We were expecting them to be signed end of April, early May, but they got signed in the, towards the end of June, right? So that's a given. Second, if I look at plant engineering, it was actually not a deal problem. It was more getting input from customer on time problem. So that book of business still is with us and therefore can be accelerated, executed. So I don't have a problem there. I have an issue in Semcon, which I don't know it will be a 1 quarter pain or is it a 1.5 quarter pain, right? So that's the only blip that I see. But given the fact that the pipeline is stronger now than it was a quarter or year-on-year, second, the 6 deals that we have won that have gone into execution, and third, there are other deals in the pipeline that we are expecting to close or very close to closing, I do have confidence of retaining the guidance. Now, also, on Smart World, it's H1 to H2 business, H2 being much better than H1. So overall, that 20% plus holds that we are at this stage.
Right. So just a quick follow-up on that. Given that you have seen scaling up in these 6 deals in the last few months, is the confidence also kind of baking in a fairly strong second quarter, which gives you enough buffer for any potential trouble down the line in the second half?
Yes, Mukul. See, I'll tell you what we did. So after I went back in April, we have spent time talking to the clients, working with them through their decision-making process. One reality is that where a deal would take 2 signatures, it now takes 4 signatures, right? That's a reality. So how do we get that done quickly is the whole thing that we continue to work on. Now, there was, that's one. Second, I'm betting on the fact that some of these deals that we are sitting on in Semcon or in consumer electronics will close faster than what I saw in Q1. And thirdly, I do expect H2 to be better than H1 as we stand today. So we're working on all 3. In fact, I should confirm to you that net headcount will at least go up by 750 people in Q2 as compared to Q1. And we're already on our way to making those offers. People have been joining us, etc. So fairly comfortable and confident. But we'll keep you updated, Mukul. I mean, we've always been very transparent, very direct, and we thank you all for your confidence in us. So we continue to work on this. We'll come back to you. We, in fact, hosted a client advisory council, first time ever in our history. So about 16 clients, controlling close to about, like I said, a huge amount of revenue and market cap came together, spent some time with us. So we've got some trends from them. We've got some, why don't you approve what you don't approve also. So fairly good conversations, candid conversations, fairly comfortable.
Thank you. The next question is from the line of Sulabh Govila from Morgan Stanley. Please go ahead.
Hi. Thanks for the opportunity. My first question is on SWC. So on the numbers that we've reported, which is 1Q F23 and the 4Q F23, just wanted to understand that in this business, is there some variability involved in other expenses because they don't change much as a percentage of revenues?
Sulabh, this is Rajiv here. I'll take that question. Like I said, we've had to restate financials of the previous quarters to include SWC. So what you see in terms of other expenses is more like to like, and hence there is nothing in addition. We don't expect that the other expenses will increase or decrease materially. This pretty much reflects what is the reality of that business.
Sure, understood. Maybe I'll take that offline. My second question is with respect to plant engineering business. So in the past 2-3 quarters, we've seen some volatility in this business. We saw a decline in Q3, and then we saw a sharp bounce in 4Q, and we thought that the vertical has sort of recovered. Now the issues could be different in different quarters, but just trying to understand that what's giving us the confidence that the volatility which we've seen in the past 2-3 quarters will not recur in the coming quarters.
Sure. So if I look back at plant engineering, and I'm scrolling through data as I look at it for you, right? If I look back at FY22, or I look back at if I go back to FY22, and I see there was a constant increase quarter on quarter every quarter, right? I come to FY23. And yes, there was a one-off decrease in quarter 3, but it continued to the upward trajectory, right? And if I look at now quarter one, we've had a blip, and we are sharing with you that some of these decisions for design decisions from the customers were delayed, and it was not a budget issue. And therefore, and the backlog that we have got, with the new orders that we have signed, with the rigor that we have put in, I do believe that this will be of the past. Additionally, we are winning new digital factory and digital plant deals from customers in plant engineering that give us the confidence that we will see upward from here. In fact, now we are adding some resources that we can immediately hands on deck to make sure we are able to deliver. I also want to share that we have established now outpost in the US for clients in plant engineering that should help us in terms of engaging a lot more local talent, and the same will be happening in Europe. So we're fairly comfortable with it.
So, look, this is Rajiv again. You may have seen, of course, our SEBI financials and tried to compare the other expenses for any variability. To clarify, in this quarter, there are lower subcontracting costs and, of course, a lower legal cost as well, and nothing to do in relation to the Smart World business. Again, I just wanted to add, because it's more like to like. I hope that clarifies, Sulabh, your point on other expenses.
Yeah, sure. Got it. Thank you.
Thank you. We have the next question from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi, good evening, and thanks for the opportunity. So when you look at the SWC business on the numbers that you have reported, is the Q4 to Q1 dip the usual sort of seasonality in the business? And typically, if you could give some color in terms of typically what's the sort of, the mix between first half and second half, how does it normally look?
So Rajiv, you want to take that?
Sure. So, Nitin, to your point, yes, this business is seasonal in nature. Typically, you will see H2 to be better off compared to H1. In terms of mix of business, you will see H2 to be at 60% versus H1 at 40%. So that's the reason we say that you tend to see H2 to be better off compared to H1.
Sure. And the variability from Q4 to Q1 that we have seen this time, is that a common feature of this business, or do you think as you spoke about, I think 130 million and 310 million deals, as these deals keep adding up, that should sort of come off? How should we think about it, at least as we go over the next 12 to 24 months?
So 2 points here. One, the point that I made that H2 is better than H1, and hence you're seeing that Q4 had a better off revenue for SWC when compared to Q1. That's one. Second, when you compare Q1 of this year to Q1 of last year, in fact, they have done better off, right? So I hope that clarifies to your point, Nitin.
Sure, perfect. That's helpful. Thank you. All the very best.
Thank you. The next question is from the line of Vimal Gohil from Alchemy Capital Management. Please go ahead.
Thank you for the opportunity, sir. My question on SWC has been answered. Second question is on the industry per se. We have seen a lot of influx or a lot of news on a lot of global companies setting up GCCs in India, and there have been news of a lot of aggressive hiring from them. How do we participate in this particular trend? Do we partner with them in their in this entire process of setting up their centers, or do we look at these GCCs as our potential competition? Thanks.
Sure. Well, thank you. So, look, I'm part of I just joined the NASSCOM Executive Council and the only engineering ER&D company member on the council, other than gentleman who's been co-opted from the ER&D council, right? So, on the general council. So here, GCCs are an opportunity. If I look back and I look at the number of STEM graduates coming out of colleges in India, it's huge. It's more than 2 million people coming out in the per year in STEM, right? So they will find their ways to global competency centers. Now here's the good news in the silver lining. All the business that was potentially going up to a Ukraine or going up to a Russia or going up to other parts of Eastern Europe has started getting diverted to India. A significant part of what was being given to China has been given to India. So if I look at it, the India pie itself has grown, right? Second, if you would have talked to me 15 years ago, I would have said they are all competition. But I've learned, the industry has learned, everybody's learned to coexist. In our customer premises, often there are discussions that happen about green badge and red badge, or blue badge and red badge. Blue badge or green badge is their own employees, while, red badges are people like us. They continue to look at what is it that can be is core. We will keep whatever that could be contextual or that was core yesterday or, could be given to us. Additionally, GCCs focus on only their area of focus. So an automotive will focus on automotive. Telecom will focus on telecom. But if they need cross-domain vertical expertise, they will not be able to deliver to that. For example, I've been executing a number of connectivity projects for a lot of my auto customers who have their centers here, but I work with their teams in Europe, US, and they give me work directly, right? So that cross-vertical domain expertise that we bring is not there with GCCs because they are single-cylinder focused. Lastly, the fact to be considered is that the world is moving to a lot more fixed price, consolidated work kind of model. So therefore, we are the gainers there because they look at us and they actually let us deliver on an envelope basis rather than worrying about, attrition and this and that. So I do welcome GCCs being here. We've been hiring from them. They've been hiring from us. It's a two-way street. I do welcome the whole ecosystem being built up in India because overall it adds to the fundamentals of the ER&D business and companies like us.
Right. Amit, just a follow-up to that, how do you look at our cost structures versus the GCC cost structures? Is there a significant differential for our potential customers to say that the Indian ER&D service providers like us are still have a better edge in terms of executing projects at a much better cost efficiency versus them doing within their captive or within or in-house?
Vimal, actually, two things here actually. Number one is that GCCs, their cost structures are higher than ours. That's clearly the case. They work on a cost center model, and we work on a profit center model, right? Number one. Number two is because they are single cylinder. They can't offer a lot of career growth or job enrichment to their software engineers or hardware engineers, etc., because they have to do the same work. In our case, we are able to provide that. So I will not say we pay less, our cost structures are lower, but if I look at the total package of what we would be able to offer to our engineers, which is career growth, which is job enrichment, which is job rotation, plus customer interactions is something that we are able to provide that are not there in an in-house setup. So I do believe that's there, but having said that, I again will reiterate, together we are creating an ecosystem that is good for India and good for sourcing from India.
Thank you. The next question is from the line of Ravi Menon from Macquarie. Please go ahead.
Hi, thank you. I just want to check on the growth in North America. It looks like we've seen some good revenue addition there, and it's almost as good as what we saw last year. So what were the things that came in well this quarter in North America?
Ravi, Rajiv here, I'll take this one. So it's more relative in terms of when you look at the growth for North America, and that's probably because we have restated the Smart World financials in Q1 as well as in Q4. And because Smart World is a cyclical business, you're seeing, of course, Q1 to be lower relative to Q4. and consequently the proportion of business that you see shows a growth in North America when compared, right? So it's just relative. That's what I would say, Ravi.
Thank you. And secondly, you said that semiconductor, you're starting to see the decision cycles get better. So I want to check, but you also said that you don't know if it's probably a one quarter of pain or more than 1 quarter. So could you just explain it?
So I'll answer it two ways, right? One, on Semcon, I will share, but I will then request my colleague Alind to add to what he's seeing in the market as well. So one, from a Semcon standpoint, there is a little bit of pain that's there in terms of, they are shifting. Consumer electronic devices are not being sold so much, so the demand was not there. They are all trying to switch to data center chips and AI chips. Today, all of a sudden, AI is the only word they use, everybody uses, right, including all of us. So therefore, there's a shift happening. In fact, and we see that spend coming. Now, will that come in a quarter? Will it be 2 quarters? To be seen. I would request Alind to add on the color of the market as he sees today in North America.
So, we are working with more than one Semcon companies. So, totally, if you look at, we work with about 4 or 5 Semcon companies. And if you look at the trajectory which is there, broadly driven by AI, and then by default, the requirements at the data center for them to be up and running, we see that continuing. There are chips which are going to come in market which are going to change fundamentally the way that compute is going to happen. We are lucky that we are involved in quite a few of them. We do believe that in about a quarter's time, we will see the growth trajectory come back up again, and we are confident of the progress there.
Thank you.
And are you using those downturns of semiconductor to deepen your capabilities in any areas, any white spaces, maybe in the analog side or anything else where you think you lack?
So from a capability standpoint, Amit, again, I do believe that we have capability across the spectrum, and we are working towards, in fact, we've executed projects now on 7 nanometer as well, and we continue to work on different areas, in fact, tying up with the global ecosystem as well. So you just have to start. Some of these have to get signed off and start.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. My first question is, last time in the Q4 earnings call, we said that more than 20% constant currency growth, the organic growth would be more than 10%. Whether that assumption changed or we expect that growth could be slightly higher in case of SWC calculation, because the first quarter run rate for SWC on a YOY has been healthy. So whether the 10% organic growth guidance, more than 10% still stands?
So, Sandeep, thank you. So the way we look at it is, number one, as you've seen numbers, we have reported Smart World mostly in the Semcon, in the telecom segment, right? Because operationally we have integrated. There are leaders from our Smart World, L&T Smart World family that today are responsible for two of our centers in India, execution centers. There are leaders, senior leaders from our side, from the LTTS heritage side, that are responsible for the next-gen comms business, which has been integrated between both of them. So we do commit to that 20% plus CC, and we are watchful that we don't sign lower margin deals, and that has been a conscious effort and, shall I say, cadence developed in the last 3 months in the company to ensure that. So I'm confirming 20% plus CC, H2 will be better than H1, and broadly the split will be what we have told you.
Okay, so organic growth will also be more than 10%.
At this stage, 20% plus, yes, organic 10% plus, and that's where we are. But you should know that both the teams are merged and integrated.
next question is from the line of Bhavik Mehta from JP Morgan. Please go ahead.
Thank you. Just one question from my side. Just going back to the guidance, how should we look at the mix of growth within your portfolio? Do you expect all verticals to show strong growth going forward, or do you think that some verticals will do better than the others, and hence, they'll have to do the heavy lifting to offset weakness in maybe some other verticals? Just a color on that would be helpful.
Sure. In fact, I'm going to answer this two ways, if I may. One, I'm going to give you an industry view, and then I'm going to ask one of my colleagues here, Abhishek, to actually talk to you about what we are doing in software-defined vehicles and AI, because that's a huge path forward for us. So from an industry standpoint and growth standpoint, I do believe that transportation will continue the strong growth we've had because of the differentiated story of EV that we have created and the early investments in SDV that we are doing. When it comes to industrial products, given the fact that we are seeing deal closures happening for us in digital as well as software platforms and people discussing AI in a very interesting manner for shop floor applications for us, we believe that growth for that will continue, not maybe at the same rate of transportation, but better than what we have done this quarter. We do see the growth continuing. Plant, we do see the growth coming back next quarter and then continuing from there. Our backlog is fairly strong, and people continue to do call us for designing of newer plants, expansion, etc. And with this outpost we are creating in the US, which has already been staffed, we are very confident that it will grow. Now, the two areas that I am a little conservative about, one is high-tech. Even though next-gen comms will continue to grow, given 5G, cybersecurity, I don't know how long the pain in Semcon and consumer electronics will continue. I do believe it's a quarter off, but we don't know. So that's something that I'm a little concerned about at this stage, and cautious is the right word. And finally, in medical, we've had some good traction, some very nice dialogue around connected platforms, Quora, AI. But it's again, how much do they want to give and do in the same quarter is to be seen. So that's where we broadly see it. I would invite my colleague Abhishek to talk a little bit about investments we are making in AI and SDV. Abhishek, because that will help us in terms of growth as we move forward.
Yeah, thanks, Amit. So clearly, as our customers, Amit earlier mentioned about the advisory council, we are clearly seeing SDV, AI, and of course the third leg is cyber security as the three legs where we see a lot of investments coming in. The good news is from a timing perspective, the SWC acquisition that we made, the whole NGC, next-gen communication skills that comes through that, and the cyber security area are a direct fitment into the SDV space. And why I say that is because if you look at the software-defined vehicle architecture, a lot of it is about high compute architecture, and what that means is the skills that come from 5G, Ethernet, and areas are directly relevant for the way the vehicles are going to be designed. And interestingly, cybersecurity is a sweet spot for us because vehicle SOC is something that needs automotive skills and deep cybersecurity skills, and this acquisition gives us both in a very nice way, and that is probably going to be one of the key differentiators as we get into the space. I mean, as we speak, we're already doing at least 4 or 5 SDV programs for most of the customers acting in Europe right now, and we see a decent pipeline on the SDV front. Coming to AI, our sweet spot there is going to be manufacturing, automotive, and medical. And here also, I think the domain expertise that we bring to the table, it's very clear that AI is not just going to be about technology, it's about domain as well. And our deep domain expertise in 3 of these areas definitely helps us take some good strides ahead. So we will be, of course, focusing on these 3 segments. But apart from that, the investments we have done over the last couple of years, we have patents on AI-specific solutions as well. That should help us. The work we do with hyperscalers, semicon partners, I think this is a great recipe for different domain segments coming together to provide domain-specific AI solutions to our customers. In both of these areas, we are investing big time in internal trainings and the partnerships with various entities in the ecosystem itself. And you will definitely hear more from us in the coming quarters on these areas.
Thank you.
Thank you. The next question is from the line of Rohan Nagpal from Helios Capital Management India. Please go ahead.
Hi, am I audible?
Yes.
Hi. Thanks for the opportunity. One quick question on your India business. Notice that there is significant reduction there's about a $10 million reduction in your India business. Is it just on account of SWC seasonality, or what is going on here?
Yeah, that's largely SWC. I don't see it another way.
Okay. And then one of the things you mentioned was the deals that you've signed have already gone into execution. So that's fairly swift. Could you provide some color on the timeline of deals in terms of what is the typical timeline from signing to execution, and some color on the pipeline that you're currently seeing?
Sure. So when it comes to the deals that we signed, the 50 million deal actually was something that we had been pursuing for more than about 4 months. And it took time, and we actually have been, we were waiting, we were investing and waiting, right? And it took a lot of decision, approval, etc. to go through with that, but it's already moved to execution, and we've gone live. Now, the other 5 deals that are there, the 10 million plus deals, they have all gone into execution, I want to confirm, towards the last week of June, right? And ramping up as we speak, and should get to steady state sometime in this quarter. So we are continuing to work on those. Now, as an example, one of the high-tech deals that we signed, 10 million plus, not the 50 million plus, that took us 3 months and took us multiple meetings to sign. So what we have done as a team is that we've actually improved our funnel. We've increased the number of deals that we are chasing. We have hired more salespeople. They are on the ground and leaders. And I believe that, therefore, we are comfortable with the fact that we'll have to put in more effort to be able to do this. The moment the deal gets signed, right, the ramp-up is fairly immediate. So these are not long-term that they'll take 6 months, 9 months to do. Ramp-up is immediate. And therefore, we've beefed up our recruitment engine as well as Abhi, who's very passionate about the Global Engineering Academy, is also running full-time to make sure that we are able to repurpose people, turn them around, etc. In fact, in one of the particular deals that we signed, which was not a 10 million deal, because it's a shorter period, we have actually, we had invested in hiring and holding about 100 plus resources for some period, and they have gone live now in billing. So some of that training upfront execution is required. And we have more deals on the back of these that we are working on, and we'll continue to update you as we close them.
Thank you. The next question is from the line of Mihir Manohar from Carnelian Asset Advisors. Please go ahead.
Hi. Thanks for giving the opportunity. Sir, largely wanted to understand on the synergy which is there, the SWC acquisition. So which are the internal KPIs that we are tracking, and how are we progressing on those KPIs, that internal KPIs? That will be really helpful. My second question was on the deal pipeline. You mentioned the deal pipeline is quite strong, has improved materially. If you can quantify, what is the quarter-on-quarter or a YY improvement in deal pipeline, that will be really helpful. And specifically, which are the areas where you are seeing good deal pipeline in that context? And my last question was just on the external environment. You are appearing to be more optimistic on the external environment when compared to your earlier commentaries. So if you can throw some more color, is the external environment worry just behind us, and how do you see the external environment per se? Yeah, so those were the questions. Thank you.
So this is Rajiv here. Let me take the part on the synergies from SWC acquisition. So we've of course briefed this earlier as well. 3 areas that we are working towards. The integration did conclude as of April 1, 2023. So both the companies are now together, and we are reporting SWC under our high-tech, telecom and high-tech segment. In terms of synergies, 3 areas. One, internationalization of revenue. Amit did talk about that we beefed up our sales leaders in US, in Europe, in Middle East, and clearly the idea is to build pipeline. Some of that progress indeed has happened. The second is in terms of improving the EBIT margin. SWC has been a lower margin business, more so because most of the revenue has been India-based, right? And of course, taking it international will help us getting comparable margins, much like our heritage business. And third is in terms of improving DSO. DSO, because the deals that we are executing in India are deals that are with the government entities. So as we do deals with global customers, we will see DSO terms closer to what we have in heritage LTTS business. So these are the 3 areas. We'll continue to update. We did mention that our aspiration in terms of the combined EBIT margin is 17% levels. In terms of DSO, the range that we maintain combined is between 115 to 117, and we will continue to update on that. Of course, Amit did reiterate in terms of the growth aspiration, which is 20% plus, including the SWC acquisition. Amit, you want to take the second one, please?
Sure. Pipeline, where and its external environment. If I look at external environment, the fact that we are in 5 segments is what gives us confidence. When one goes down, another goes up. It is a portfolio. That's point number 1. Number 2, being an end-to-end engineering provider from mechanical to hydraulic, electrical to plant engineering to digital skills, and in that, across the stack from VLSI to hardware to software, firmware, all that gives us the confidence that we are fairly in the right place. Now, having said that, I'll tell you where the problem is. The problem is that some of these deals that we are talking about, and we have chunkier deals like the 50 million that we closed in our pipeline. So the number of 50 million plus deals, the 25 million plus deals for us at this stage is higher than it was last quarter, or it was same quarter last year. And that is driven by the fact that some of the investments we made in EV, some of the investments we made in digital manufacturing, some of the investments that we made in VLSI capabilities is coming to bear, and digital skills. Now, so that's what gives us the confidence. Now, the issue is, instead of 2 signatures, stuff is taking 4 signatures. In reality, I will not shy away, I will acknowledge it. I mean, I should tell you the number of miles that Alind or even Rajiv, Abhishek, our HR head Lax, is putting on in the last 2 quarters is much higher than they would have traveled over the last year, because clients need that reconfirmation from the entire management team and not just 1 or 2 people, right? A. B. In Semcon and consumer electronics, like I said, there's a little bit of pain left. I cannot quantify for you how long, but that's the reality. Third, any project that doesn't have a profit pool or a revenue pool associated and is being done for the love of mankind or womankind is getting delayed. So these are 3 realities that are there. But having said that, we continue to be agile. We continue to look at various areas, like I requested Abhi to talk about today on SDV and AI. We are thinking ahead of the market, and I believe that these investments will carry us forward.
Thank you. The next question is from the line of Aniket Kulkarni from BMSPL Capital. Please go ahead.
Am I audible?
Yes, please go ahead.
Yeah, so just a small question from my side. It is regarding the ROE number which you are doing right now. So are we comfortable at these numbers, or is there any specific bracket where we want to be going forward?
Aniket, this is Rajiv here. So, of course, you may be looking at ROE at a quarter level, but we certainly try to aspire for an annualized number. At this stage, we are comfortable in terms of the ROE where we are, or rather where we ended for FY23. The aspiration certainly is to improve at the back of 18% by Q1 FY24. So, Q1 FY26. So we believe over the period of these next 5-6 quarters, we should be able to improve the ROE. But at this stage, we are comfortable with where it is.
Okay. Thank you so much, and best of luck.
Thank you. Ladies and gentlemen, we will take that as our last question for today. I would now like to hand the conference over to Mr. Pinku Pappan for closing comments. Over to you, sir.
Thank you all for joining us on the call today. We hope we were able to answer most of your queries, and happy to do follow-ups with you through the quarter. With that, we're signing off from this quarter's call, and have a good day and wish you all a great day ahead. Thanks.
Thank you. On behalf of L&T Technology Services Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.